Good day everyone, welcome to PhillipCapital's Weekly Market Watch. I'm Samuel from the Private Client Service Desk and I will be bringing you some views on the US dollar and other major currencies. In last week's market, we saw a rally during the midweek on risk assets after tensions were lowered in the Eurozone and conflict in the peninsula, specifically in South and North Korea, was seen. Here's some geopolitical information that contributed to this rally. US ADP employment services data saw an additional 93,000 jobs in October. The Fed's Beige Book survey saw growth in 10 of 12 regions as manufacturing and retail expanded, where festive demand for goods and services is expected to grow. Eurozone turmoil appears to have subsided as the market speculates that the US may commit a larger amount to the IMF for assistance to the EU. PMI data in China exceeded expectations and the markets are expecting a higher GDP ending China's financial year. Goldman Sachs on Thursday recommended US bank stocks, junk bonds, commodities, Japanese stocks and China yuan as first of the firm's top trade for 2011. With such optimistic sentiments in risky assets, I am anticipating a possible rally in equities, commodities and risk currencies throughout the end of the year. This is helped by the economic stabilizing mechanisms drawn by the US and European central banks that aims to inject cash to prime their economies gradually. On the outlook of risk currencies, the Aussie dollar is currently traded at 0.9900 region, which is approximately 300 basis points below its 20-year high at 1.0200. This was created by the expectation of a weak third quarter GDP and retail sales number in November in Australia, as it greatly reduced the possibility of a rate hike through 2011. On this note, we could have likely seen the market price in on this weak data and completing the retracement with near-term support seen at 0.9600 in the coming weeks. If we continue to see the daily chart closing above the 0.9600 handle, my projected target will be a test towards the high created on 6th of November at 1.01825. On risk aversion currencies, the yen is currently traded near 8300 level and has tested its 15-year support at 8000 in the month of November. The weakness in yen was contributed by tensions built up in the peninsula, and as a result, a shift in demand for an alternative safe haven currency, which is the US dollar, was seen. Investors felt that holding the dollar offered equivalent benefits to holding the yen, and especially when it is cheaper. In my opinion, if the market continues to favor holding a cheaper dollar on risk aversion, there will be a paradigm shift in future risk aversion moves. Bringing this view to the market, I'll be expecting a stronger US dollar against the yen and anticipate a test at the 8600 level and shorter term retracement target found at 8200. I hope my insights are valuable for your reference and please look forward to next week's Market Watch. Thank you.